Some investors might consider this stock an easy money stock. Well, in today's video, I'm going to cover their business, growth catalyst, competitive advantage, financials, and valuation of the stock we're talking about, which is of course Discovery. Yes, I'm talking about like the Discovery Channel Discovery, and before you click away assuming this is a boring stock that's not for you, that's usually where a lot of the best opportunities lie. Trust me, this one gets a little bit exciting, so let's do it. What's going on, everybody? My name is Matthew, and today we're talking all things Discovery, ticker DISCA or DISCB or DISCK. Discovery is one of the value investments that's catching a lot of investors' eyes lately in today's market, including none other than Michael Burry. Burry has put in 18% of Scion Asset Management's portfolio into DISCK, making it by far his largest position. And I'll try and explain why I think he has put it into DISCK instead of DISCA later in this video. So let's start with an overview of the business. Discovery operates both within the US and internationally, but within the US, some of its most popular channels include Animal Planet, TLC, Food Network, HGTV, OWN, and of course Discovery Channel. There's also an offer on the table, a proposed merger with Warner Media that could create a completely new company that would own all of these channels and other prominent names such as CNN, HBO, Warner Brothers, TBS, Cartoon Network, truTV, and more. The newly formed company would also operate both HBO Max and Discovery's new streaming platform launched in January, Discovery Plus. But let's take a step back for a second and just consider Discovery as standing alone as its own business without discussing the merger quite yet. Taking a look at their business overview from their 2020 10K annual report, they break down their revenue for us. So 52%, the majority of their revenue is from advertisements that they sell on their networks and digital products, for example, a commercial on the HGTV channel. 46% is from fees from distribution of their content to cable networks and also direct-to-consumer or DTC subscriptions, such as, again, their new and important Discovery Plus platform. And of course, the last 2% is from smaller things like licensing for consumer products, for example, an Animal Planet stuffed animal. Now, personally, I think we're going to see advertising revenue actually slowly decrease as a percentage of revenue for Discovery while distribution grows. I imagine it'll look something similar to this graph here, where we see advertising revenue slowly drop as cord cutting continues and cable advertisements and cable in general kind of slowly die off or demand less of a premium. However, distribution revenue would shoot upwards as Discovery Plus, their new streaming platform, reaches, say, 50 million subscribers within the next few years. And Discovery Plus is included in their distribution revenue as a direct-to-consumer revenue stream. And this kind of makes sense. It's confirmed by their 10K annual report where they state they had a 5% decline in network subscribers and a 3% decline in subscribers to their fully distributed networks. Thus, they're investing more heavily into Discovery Plus and other DTC products. In other words, cable is dying, so we have to invest more into streaming. But don't count out cable just yet, because cable will not be useless for Discovery. In fact, it could even be considered an advantage where their cable business will continue to generate billions in cash flow every single year that can then be reinvested into Discovery Plus. And also it should probably be used to pay down their debt, which is a big risk for this stock, but we'll talk about that later. Now, if you can't already tell by how many times I've mentioned it in this video already, much of this thesis and future growth for the company relies on Discovery Plus. But streaming is already so crowded, so they need to have a competitive advantage. And I think there's probably a couple that could be made for Discovery. First is their content. They are leaders in nonfiction with channels like Discovery and Animal Planet, and also news coverage with CNN. They also have exposure to sports, such as their 12-year partnership with the PGA Tour and streaming rights for Tokyo 2020 in Europe, which went surprisingly well. Their second competitive advantage over other streaming services like Netflix is actually the fact that they own the majority of the content they're streaming. Netflix, for example, when first starting their service, burned a hole in their pockets because they didn't own much of the content that they were streaming to their subscribers. Then, once the streaming wars broke out and everyone wanted their shows back, they had to start creating original content, which meant spending even more money. So owning the majority of their content from the jump and already having tens of thousands of hours of content from the beginning is going to help Discovery close the gap a bit quicker with these streaming giants. The growth of Discovery Plus has also been quite impressive so far. They launched on January 4th, and since then, within 8 months, as of August, they had over 18 million subscribers. And by the way, they're currently running a pretty crazy deal offering 40% off your first year for as low as $2.99 a month. month. That wasn't a sponsorship. I'm not affiliated with them. It just seems like a crazy good offer. Not to mention, if their deal with Warner Media goes through, they will own another massive portfolio that we touched on before, as well as HBO Max, which already has 67 million subscribers as of July and is expected to have over 70 million by the end of the year. And that's probably what we should talk about next, the merger. In this deal, AT&T would receive $43 billion in a combination of cash, debt, and Warner Bros. Retention of certain debts. Together, AT&T and Discovery would be forming a new company called Warner Bros. Discovery, comprised of Warner Media and Discovery, where AT&T shareholders would own 71% of said new company, and Discovery shareholders, people buying DISCA, DISCB, DISCK, we would own 29%. The deal is expected to be closed in the middle of 2022, but there's still a possibility that doesn't go through, which is why it's important to analyze Discovery on its own, as we just did. And lastly, the new company will be able to stream to over 220 countries and territories and in 50 different languages. Now, since the deal was announced, the market has not reacted positively, and I think a lot of that has to do with the uncertainty surrounding the deal. We have a general idea of how the deal may be structured, but we don't have the specifics yet, at least not to the point where Wall Street can create predictions or models or anything like that. And we all know that Wall Street absolutely hates uncertainty and is more risk averse when it comes to not knowing the potential outcomes. But with a 30% drop since the deal was announced and such a cheap valuation that we'll analyze in a second, perhaps a bad deal's already starting to be priced in. I mean, at what point does a deal get so bad that it will fall even further than 30% from when the deal was announced? And at that point, you also kind of have to trust Discovery's management that they won't make a deal that would be so terrible. That said, if it does go through, the CEO of Discovery did mention that he sees over $3 billion in cost synergies within the merger. In fact, he said by 2023, we'll be generating over $14 billion in EBIT, which is earnings before interest and taxes, and over $8 billion in cash. He also said, quote, "This company is going to be a free cash flow machine." The merger would also probably create the most diverse portfolio in all of streaming. And now to talk about valuation. When using multiples, you want to stack it against its peers. So when stacked against companies like Viacom and Fox, we can see it has a higher than average forward EV to revenue multiple. But in this case, I'm not too bothered by that, as I'm more focused on profitability and cash flow. Discovery has a slightly higher forward EV to EBITDA, which is a profitability measure, but it does have a cheaper forward PE, and almost half the average multiple for forward price to free cash flow. And I would say the biggest discrepancy or difference in valuation does come from the price to free cash flow multiple, and when compared to the rest of the market, the average price to free cash flow of the S&P is around 12 to 14, whereas Discovery's again is in the 6 range. And if we want to do a direct comparison to Viacom, Viacom's forward PE ratio of 10 is also higher than its current PE ratio of 7. This indicates a drop in earnings, whereas Discovery's forward PE ratio is lower than its current PE ratio, and that's a good indicator because it means that we expect earnings to increase. Another reason why Discovery is probably trading cheaper is because of its debt, and whether or not it can service its debt, which is another fancy way of saying maintaining its debt or keeping up with payments. There's that, also combined with, again, the uncertainty of the merger. But let's focus on the debt really quickly. So to do that, we got to start with the financials, and starting with the balance sheet, right off the bat, we see that we have $6.7 billion in current assets versus $3.5 billion in current liabilities. That gives us a current ratio of nearly 2, telling us that they're in good financial shape for at least the next year. Remember, we want that current ratio above 1. Moving on to their debt, which is one of the bigger concerns, they have almost $14.5 billion in non-current debt, meaning that debt is not due within the next year. That might be a big scary number now, but much of this debt is not due for several years, in some cases even decades. Discovery even has debt that doesn't mature until 2055. And based on current projections, Discovery is expected to generate over $2.1 billion in free cash flow in 2021 and over $2.4 billion in 2022. In other words, this is cash that they can use to pay down their debts. And with over $2 billion in free cash flow being generated every year, $2.8 billion in cash on hand, and $2.6 billion in current receivables, I would say this $14.5 billion in debt is very serviceable for the foreseeable future. Now moving on to the income statement, their Q2 earnings report shows that we're back on an uptrend after a slight decrease in overall revenues in 2020 and stagnation in the years before. However, we do see a decrease in their profit margin, which I would argue is primarily attributable to the launch of Discovery Plus. Right now, they're spending a lot more on marketing and content creation with the big launch of the new product, so expect their margins to be a bit tighter as they roll out this platform for the next year or two. So if the merger does go through, through, the new company would have $55 billion in debt. Now on that, management expects gross leverage to drop from 5x to 3x about 2 years after the deal is closed. And gross leverage as a definition is calculated by dividing their total debt by the trailing 12 months adjusted EBITDA. Additionally, I'll remind you that the CEO of Discovery says they'll be generating $8 billion in free cash flow by 2023. Now, whether or not you believe him or believe that projection to be accurate, it is up to you. And that's why this calculation of whether or not $55 billion in debt is serviceable for the new company is definitely going to require some more work on my end and some more clarity again on the deal. That said, expecting the merger to go through, I still think this is a very attractive investment and with limited downside. Now, I'm not quite ready to pull the trigger yet, so I'm not considering this a buy video, but it's one that I am very close to perhaps initiating a small position on. So it's time to talk about what I'm doing. First off, from my understanding, there is no real difference between DISCA and DISCK other than voting rights and volume of shares traded. DISCA, as I'll call it, I guess, has some voting rights while DISCK has none. I, along others, believe the voting rights are sort of irrelevant, and I would even argue that volume isn't as much of a factor anymore. A while ago, DISCK would maybe see 700,000 shares traded in an average day, and that's really not a lot, but now it's averaging over 3 million shares traded, which is plenty enough in my opinion. DISCA trades about 5 million shares a day for reference. Now, the reason why I think Michael Burry bought DISCK was because at the time of buying his shares, and I could be completely wrong, he's Michael Burry and I'm just me, but at the time of buying his shares based on his 13F filing, there was likely a discrepancy in price or an arbitrage play to be made between DISCA and DISCK. You see, they should be pretty close in price all the time, but there was a brief period where DISCK was some 10 to 15% cheaper than DISCA. So that's my guess as to why he bought DISCK. Simply put, it was 10 to 15% cheaper than it should have been, and he also likes Discovery as an investment. If I do end up buying Discovery, I'll probably just end up buying DISCA. I don't think it matters significantly because as of writing the script, there's about a 0.4% premium to the DISCK shares, but I think either one should really be fine. Of course, always do your own research. So again, I'm like 90% of the way there on being convinced on this investment. I'm being really selective with my different moves being made today because of one, how expensive the market is, and two, I already have a decent number of positions, so this idea has to be better than my other 15 or 16 ideas. I think 15 right now. I'm also kind of waiting for more transparency or clarity on the merger and the deal structure. Of course, I think a lot of investors are doing that, which is why it's kind of just sitting at this low here in terms of the share price. And I might actually buy a little bit now and then wait for after the deal to go through and convert into new shares for the new company, because at that point, I think a lot of the institutional holders or investors in AT&T who are there for the dividend, they might actually sell their shares in the new company because the new company will not be offering a dividend, at least from what I understand. And that could even create a bit of selling pressure on the new stock once it is merged, and that could be a buying opportunity for people who want the stock for the growth potential and not just the dividend. And that would be the dividend that is no longer there in the new company. So yeah, if I do end up buying any shares, I'll be sure to let you guys know in the form of a video, and of course, all members and investor community will know in real time if or when I make that trade with full reasoning. You can check that out in the description below if it's something that interests you. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out a quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching this point in the video, you are the real MVP. Don't forget your peace, and thank yous.